Okay, cool. Well, we got a lot of new people here then. A lot of second-time seminars and some members. So again, welcome. This seminar is entitled "Introduction to Bank Trading Strategies." It's going to be a good overview of the belief behind our system. For any of the members, it'll be a lot of overview. You probably heard me say most of everything we're going to say here 1,000 times, but thanks for being here, obviously. And with that, we'll kind of get going here. So the first thing we're going to talk about, guys, is the basics, again, the basics behind the strategy, why it is we believe what we do. This is a counterparty agreement, and again, at the foundation of our strategy, you have to understand the foundation if you're going to understand anything else. This is a counterparty agreement. Most of you, if you've been in Forex, you've probably seen this agreement many times. This is an agreement that everybody, if you sign up with a broker, that is what we term as a bucket shop broker, a broker that is not an ECN broker, they're going to make you sign a counterparty agreement. Now, the most important part to this is Alpari's counterparty agreement. They all use the same one. They just simply replace their name here with Alpari. So the second paragraph says, if Alpari elects not to cover its own trading exposure, then you should be aware that Alpari may make more money if the market goes against you. Additionally, since Alpari acts as the buyer or seller in the transaction, you should carefully evaluate any trade recommendations you receive from Alpari or any of its solicitors. So why is that important? Well, that's important. The first part there, you should be aware that they make more money if the market goes against you. They sell it to you when you buy. They buy it from you when you sell. Therefore, because they're taking the other side to your trade, when you make money, they're the ones that pay it to you. When you lose money that was subtracted from your account on that losing trade goes right into their account. So if they don't cover their own exposure, which their model is to take the counterparty trade to you, so therefore they do have that exposure. So the second part there is, additionally, since Alpari acts as the buyer or seller in the transaction, you should carefully evaluate any trade recommendations you receive from Alpari. Now, it's not just trade recommendations, but it's also anything they tell you as far as how to be a profitable trader. They're essentially telling you you should carefully evaluate it because there's a major conflict of interest. So that's a very important point to keep in mind no matter what type of strategy you use, and you'll see why that's important as we move forward along here. Okay, so looking at this, we're going to break down what we had talked about before and why essentially that's so important, and we're going to start with this chart. So looking at the numbers, I'm just going to break down these numbers. If the chart changes over, we'll work with that. But anyways, looking at these numbers, if look at the chart, I'll give you guys later if I can't get it to pop up. If you look at that chart, there's a breakdown of Owanda, GFT, Interbank FX, PFG, FXDD, all your major brokers, and it breaks down a profit and loss. Now, as a best case scenario, Owanda has some of the best numbers when it comes to keeping profitable traders. So their numbers are 39.1% profitable and 60.9% losing. Now, this is on a quarter by quarter breakdown. So what I've done here and what you're seeing right now is I've broken down what 60%, we're taking 100 traders from the get-go, and we're breaking down what happens to these 100 traders over the course of 4 quarters. Now, this number may be a bit better, keeping in mind that this doesn't account for a certain set of other variables. But if you look at the chart you're looking at right now, if you're looking at the numbers on this chart, you can see that best case scenario, Owanda is running about 60%. So breaking those numbers down, again, running those numbers over the course of 4 quarters, and the chart will flip back here in just a second. If we break those numbers down over the course of 4 quarters, the first quarter, if 60% are going to lose, then that means after the first quarter, you'll have 40% that are still profitable, or 40 out of 100 traders. Now, you break that down again over the course of 4 quarters, 60% of 40 traders is 16 profitable traders left. And obviously the breakdown over the course of the year would be 2.56 traders out of 100 that remain profitable. Now, I will agree that there may be a certain set that are consistently profitable, which would increase this number. But let's, even if you increase it to 10, you're still dealing with a very small number when it comes to the amount of traders that are actually consistently profitable. And again, this is covering the basics, because if you don't understand the basics or the breakdown of the foundation of what we do and tracking the banks, then it's hard to actually understand the strategy. It's hard to have the belief structure behind the strategy. Moving on here, we'll flip over to the next slide. And looking at this next slide, so the question we have to ask ourselves when we look at these brokers and the profitability of traders with these brokers, and these numbers will span all brokers. It's not just select to those brokers you saw in the last chart. So the question we have to ask ourselves is, what do these brokers teach? And really everything boils down to 3 different segments. It's either going to be fundamental analysis, technical analysis, or automated trading in some sense. There's many different variations under each of them. I've listed a few: news trading, spike trading, long-range forecasting, pre-news sentiment under fundamental analysis. Obviously, technical analysis, there's 1,000 different things people use for technical analysis. Moving average, convergence, divergence, stochastics, automated trading, EAs, trading software, etc., etc. So there's 1,000 under all of them. You guys are probably, in your mind, you're probably thinking of many different ones in each of those categories. So we're going to put 2 and 2 together here. In the beginning, we discussed that these brokers have this counterparty agreement, meaning when they're telling you in the counterparty agreement, when you buy, we're the ones that are going to sell it to you, and when you sell, we're going to buy it from you. So remember, in the counterparty agreement, they specifically say that you should be wary of anything that we give you as far as information in trading profitably. To read it from there again, it says you should be aware that Alpari may make more money if the market goes against you. So they're telling you initially they have a direct conflict of interest with you. Again, reading it in red, you can see it on your screen now. Because they act as the buyer, you should carefully evaluate any trade recommendations that they give you. So if you keep that point in mind, if you should carefully evaluate any trade recommendations that they give you, and then on the flip side, you look at what they're teaching you, the question you should ask is, if there's a direct conflict, would they ever teach me something that's profitable? And the only logical answer to that is, if they have a direct conflict of interest, they would never teach you something they know the massive traders are going to succeed with. So then this is something for you to do individually. This is something for each person here to do on their own, and to make their own determination. You go to the brokers, you look at what they teach. Most of them, for the most part, will teach technical analysis above most everything else, meaning they're going to teach you trade chart patterns, candle patterns, use indicators. It costs a massive amount of money to use the MT4 platform. It costs a good deal of money. So why do all brokers use MT4? Well, they know they're going to get, number one, it's popular, and that's true. But the second question, or the second point to that, is that it promotes the use of indicators, EAs, trading software, all things that they know in the end are going to fail you. So again, this is not a question that I can answer for you, but you got to put 2 and 2 together. If they take the other side of your trade, then that by default means they're never going to teach you anything that's profitable. So automatically, you look at what they teach you and you know what you should not be using. Brokers are set up with no other choice but to have you lose, Rick. If brokers, now They do make money if you maintain break even. They pocket the spread, obviously. But they know that every single day there's hundreds and hundreds of traders that come into this market. There is no shortage of new traders. Therefore, quicker they can work through somebody's account, the quicker they're going to work on to the next person. It's not really a secret, but it's the fact that they're telling you right there in their counterparty agreement that looking at that from the perspective of their perspective, there is a direct conflict. So it's not really, again, it's not really a secret. It's just a matter of putting the two and two together. So moving on, then I put this little picture in here, which is quite. If you guys have watched Wizard of Oz, you all know that this picture as soon as it pops up, and essentially what we do is that we're trying to see the man behind the curtain and looking at it from the perspective of there's somebody running this market. Now, so you guys, you all recognize this picture, especially anybody a little bit older. Obviously, most younger people as well will recognize this picture. It's a picture from The Wizard of Oz, and it is a screenshot from the movie. Obviously, they get to the land of Oz, and the guy says, "Pay no attention to the man behind the curtain." So they essentially see that it's all smoke and mirrors, and it's simply some guy behind the curtain that is, portraying himself essentially to be more than what he is, and that's the basis behind what we do here. And that sounds very, it doesn't really make sense right off the bat, but this picture will tie everything together. This is a chart that anybody can get. You go to Google, you type in Forex, you go to the first link on it's not WikiLeaks, on Wikipedia, and one of the first charts to show up is a breakdown of the top 10 traders in the Forex market. Now, I believe this is of May of 2012. This is a breakdown of the top 10 traders in the Forex market. Deutsche Bank making up 14.5%, Citi 12.2%. And if you add all these numbers together, what you'll come to see is that a very small group, and I don't mean small in the sense that these are small institutions, but as far as a number of people that are trading in the market, 10 institutions control well over 70% of the volume in the Forex market. I know the big lie in this market, and this is probably one of the bigger lies in the market, is that the Forex market is too large to be manipulated. I don't care whether you have a $10,000 a day market or a $10 trillion a day market. If you control 70% of the volume in a $10,000 a day market or a $10 trillion a day market, 70% is 70%. Therefore, if you are if that 70% as a whole is looking to drive the market in one direction or the other, they will drive the market in one direction or the other. That's the bottom line. I don't care what size the market is, 70% is 70%. Okay, so like we have written here, if you understand the position the banks are taking, then you will know with a high degree of certainty what the next direction in the market is. And that's a simple conclusion. If you know what the people that control 70% of the market are doing, then you'll know the next direction of the market. This is not a secret. This is not a hidden fact. This is a fact that's in front of everybody. Again, that's a Wikipedia screenshot of the top 10 traders in the Forex market. Logically, if somebody controls 70%, that would mean they can dictate the next direction of the market. So essentially it goes to the next slide, which is the struggle for liquidity. On a daily basis, there's a struggle for liquidity in the Forex market. Because they control the mass of the volume, there's not, their biggest issue is not our biggest issue. Our biggest issue is getting the direction right, obviously, and getting the timing of that trade right. If you control the volume, you control the direction. Therefore, their biggest issue is not getting direction right. Their biggest issue is finding the buyers when they desire to short the market, and vice versa, finding the sellers when they desire to enter a position long. So with that being said, we need to start looking at the market from a slightly different perspective. It's just like that picture of the, the picture from the Wizard of Oz, that pay no attention to the man behind the curtain. If we look, and really you got to kind of boil this down to any type of strategy, as far as a technical-based strategy or an EA-based strategy or any type of trading software, it all boils down to one thing. Now, obviously, all of those different strategies are going to have 1,000 different trigger points, meaning there's going to be many different triggers for a buy signal or a sell signal. But in general, from a retail trader's perspective, and what I'm going to do here now, guys, I'm going to flip to a chart, and this will break down. We'll start looking at the charts here. And what I'm going to do is I'm going to go ahead and, let me see here. And I'll just make sure I tell you guys what chart we're on. So looking at it, and all the stuff on the chart right now, we'll start to break down. But just give me a minute here as we go over the basics. So if we look at it from the bank's perspective, again, their biggest issue is they must find buyers when they want to sell, and they must find sellers when they have the desire to buy. So we need to start putting two and two together. When you look at it from a retail trader's perspective, and you look at it from all the different types of technical analysis, whether again that's indicator based or whether it's an EA that's programmed, in order for a long signal to be triggered, the market in some way, shape, or form has to begin to roll over to the upside. Meaning most indicator-based strategies, most EAs do not trigger a long when the market is in the mode of selling off or running to the downside consistently. That's a logical conclusion. I'm sure you guys are thinking of all the different strategies that you've used. In order for a long to be triggered based on different types of either, again, chart patterns, candle patterns, indicators, EAs, it requires the market at some point to begin to roll to the upside in order to eventually trigger a long. Again, there's 1,000 different trigger points, but that is the base foundation. And so it's vice versa. If for all these different strategies, at some point, in order for it to trigger a sell, the market has to begin to fall. That's a very simplistic point. You guys all, I'm sure, no doubt understand that. And while each of them will have a trigger point, we'll take, for example, this right here. So we'll take, for example, this high right here. Now, during this move to the downside, as this market begins to fall, where are the entries going to be on the different types of indicators? Well, as the market rolls over, there's going to be, again, 1,000 different entry points, whether it's based on a market level breaking, indicators rolling over, different types of entry criteria. As the market begins to roll over to the downside, the sells start to trigger. What you can conclude from that, and again, I urge you to go back and look at the different strategies that you use. In order for a long trigger to be signaled, the market must begin to roll to the upside, and vice versa for a sell. But if we look at it from the perspective of the banks, how do they trade? Well, we just discussed that for every buyer there's a seller, and for every seller there's a buyer. Therefore, it is literally the exact opposite to how the retail market trades. In order for the banks to sell, they sell into a rising market. In order for the banks to buy, this is a 15-minute chart of the pound, and it's on the 9th of January, by the way. In order for them to buy, they need to create selling pressure. So there's a reason why you see the market break out of a high or roll to the upside before the aggressive move down. There's a reason why the market will aggressively sell off and break below lows before working to the upside. It's the exact opposite from the banking perspective. Very simply, they need to induce the rest of the market to sell in order for them to buy, or induce the rest of the market to buy when they have the desire to sell. Now that's the overview thought behind how they trade, and like FX Ninja just said, it is a basic overview of supply and demand. What we should also conclude from that, and while in a seminar we can't cover, every little nuance to it, but hopefully what we'll do is we'll illustrate certain points that begin to get you to see the overall picture, and as you look at the charts on your own, you'll start to see it more and more and more. Looking at it from the perspective, from the bank's perspective, is really our intended goal. Now, as retail traders, we're never going to understand everything. We're never going to be privy to every piece of information. It's very similar to illustration that I use quite frequently, which is if you were to take a puzzle, and that puzzle, the picture in that puzzle was of a picture of somebody you were very familiar with. How much of that puzzle would you have to put together before you understood what the picture was of? If the puzzle was a picture of your mother or your father, if you got 50, 60, 70% of that picture or of that puzzle together, you would recognize that person because it's a person that is very familiar to you. It's the same way with what we do here when we're tracking banking activity. We will never have every piece of the puzzle. But because it becomes such a familiar picture to us, and because what they do is so repetitive, we don't ever need 100% of that puzzle. What we need is a good chunk of that puzzle. Once we have a good chunk of that puzzle, we have a very good understanding of what they're doing. And that's the basis behind what we do, and the basic philosophy behind what it is that we do. So a lot of what we do, and this is one of the things that's very difficult for, I don't want to say very difficult because people tend to pick it up within a few weeks, maybe a little bit longer. One of the things that when we look at from the bank's perspective, a lot of what we do, and as you begin to understand more and more of what we do, one of the things that you'll realize is that most of what we do is exactly contrary to what the average retail trader is doing, or it's exactly contrary to what the indicators are often telling, or it's exactly contrary to what the price pattern or the chart pattern or whatever it may be is often telling at that point in time. Okay, so we're going to get into some different things here on. This is again a 15-minute chart of the pound, and I'm looking at the 8th and 9th of January. So if you guys are looking at your own charts, again, 15-minute chart of the pound, and it is the 8th and the 9th of January that I'm looking at right now. So if you're taking notes, what I would say is that at the outset of understanding what we do, everybody, and I'll look at it from the perspective of those that are members. One of the things I say repeatedly, and for anybody that is a member, I'm sure you can speak to this, I always tell them, you're going to be confused for the first week. And it's the same way for anybody that comes to our site for the first time. Because most of what we do is contrary to what the rest of the market is doing, which is, again, exactly where we want to be. The rest of the market is failing. So if we're doing what the rest of the market is doing, we're going to be failing too. But one of the things I always say is you're going to be confused, but there is that aha type moment where things begin to click. And what I would urge people to do is to take notes on what I'm going to talk about right now, because whether you're new to the site or not, as you progress through the information that's on the front end of the site, it'll make a lot more sense if you take notes on what I'm going to talk about. So the first thing that I want to say is that what we do on a daily basis is really very simple. We ask ourselves two questions on a daily basis. We ask ourselves first, where are we at in the overall market cycle? Now, when it comes to market cycle, I'm not going to go into great detail on market cycle because you just simply don't have enough time to do that. But what I'm going to do is I'm going to direct you guys to parts on the front end of the site that does cover market cycle, so you'll have more information on that. So we ask ourselves first, where are we at in the overall market cycle? And the second question that we ask ourselves are, where are the high probability points? Okay, so just as an overview, before I talk about what do I mean by high probability manipulation points, when we talk about market cycle, again, I'll give you guys a link to a video on the front end of the site that breaks down market cycle a lot more, and you'll start to see this. But two of the things that we talk about repeatedly is the fact that the market, they tend to cycle the market in 3 cycles to one direction or the other. Now, this is something that is not proprietary to Chad and I. This is something that has been around forever. The market, all markets, since the dawn of markets, have long before computers, have tended to cycle in 3 cycles in one direction or the other. Because we know the banks control the volume, we can conclude that they're in control of the market. Therefore, we say the banks cycle the market in 3 cycles to one direction or the other. So market cycle gives us a very good indication of the next day's direction. There's a reason why in the daily market reviews that we do, in those videos, I list the expected direction for the following day as well as the exact points where I expect them to move the market from. Now, how are we able to do that? Well, the market tends to cycle in 3 cycles to one side or the other based on where we're at. And again, I'll just give you guys, I'll give you that link at the end of the video. But so that's the very foundation. That's the answer to the first question. So that's the answer to the first question of where are we at in the market cycle, and that's the overall cycle. Now, the second question that we need to answer are, where are the high probability points, and exactly when are we going to look to trade? So the boxes that you see on the chart, and I'm happy to, I think you guys, I'm not sure if this was something a member made for us. I don't know. You can find a indicator that does what this does. It's nothing proprietary to us. It's a very simple indicator. There's one called iSessions. There's one called Paramount Work Time. What it does is it blocks out a certain time session. The larger box that you see here is the Asian session block. Now, what you want to set your Asian block to, and this is, again, if you're trying to set your charts up like ours, the Asian blocks should end at 2 a.m. The time between, and you can look at the chart, you'll see my cursor here. So the time between when, let's let it move. Okay, so the time between when this Asian block right here, when this ends, any time I mention will be in Eastern time. So the end of this block here is 2 a.m. and when the New York session starts is 8 a.m. So the gap between the large box and the skinny tall box is 2 a.m. to 8 a.m. So I'm going to type that in here. The only times that we look to take a trade are from 2 to 5 a.m. and from 8 to 11 a.m. Eastern. Write that in. So what that means is that we want to trade the first 3 hours after this Asian box closes, and we want to trade the New York block, which is from 8 to 11 a.m. So getting back to what we were originally talking about, we want to ask ourselves two questions. Where are we at in the overall market cycle? So have they given a first push up? Are we in a second push down? You know, what cycle are we in? And that's the question we're going to answer. Essentially that is a very important question that we ask on each individual day. Now the second question that we answer, and again, I'll give you more information as far as cycle's concerned. I'm just gonna, you guys can copy this later. I'll put this link in a couple more times because you can copy that and bookmark it right now. So anyways, we discuss overall cycle, but then what we want to talk about is where the high probability points. And this goes right back to the foundation of what we talked about this morning. We understand that banks need sellers when they want to buy, and we understand that banks need buyers when they want to sell. So what we're going to look for, if, for example, in this situation, as you look at the chart here, what you'll see, and I'm not going to break down all the little nuances to it because it really, for the illustration of what we're going to talk about here, it really doesn't matter. And I'm not going to break down why exactly that was the first push down. That video will break that down more for you guys. But we had seen a first push to the downside in the pound. So we had a first push down. So the following day, as we asked ourselves the question of where we at in the overall cycle, we said, okay, we have a first push down. So therefore today, we should be looking for the second push to the downside. So that was the first question we asked. Now the second question that we asked is, where's the high probability manipulation point? Now this is a pretty simple thing once you really get to understand it. And if you were to ask yourself, anybody in here, if you were to ask yourself, what is the most common thing that all traders look at? I don't care what, if you're watching CNBC, if you're on Forex Factory and you're looking through all the strategies, there is always some talk of support and resistance. Always. I don't care if you've been in this market for a week or if you've been in this market for 10 years, almost every single trader will understand the basics of support and resistance. Why is that important to us? It's important to us because that gives us a very good indication of where the orders are going to be sitting. I don't believe CNBC either. We got one thing in common there, Alvin. It's very important because it gives us the indication of, again, where are the orders going to be sitting. So there's a reason why on any given day we can peg the high probability manipulation point pretty accurately. When we're wrong, generally the market shows no response to that level and we get a no trade situation. And we'll walk through that as well. So as we look at this day here, why, and just as a note to be fair, for me this would have been I'm not going to really get into all that explanation. I'm just going to break down the basics here. Sometimes I get caught up trying to explain all the little nuances, and when really, like Jersey said, that 3-part video series, that first video there, guys, and is the first part to a 3-part series. We have many traders who failed for years or who are new to the market, who do very well, who are members and who are not members. It doesn't really matter. A lot of the information is on the front end of the site. One of the things you'll notice real quick before we get back into what we're talking about is that there's no fluff information on the front end of day trading Forex Live. If it's not useful, it's not there, and that's the bottom line. And just like you said, I've seen it change people's trading and change it dramatically. So I would just urge you to after the seminar go through all 3 of those videos. That's a very good basic overview of everything in those videos. So anyways, moving on to this. We had the direction expected for the day. Why did we have that direction expected? Well, because it was in the direction of the current market cycle. So the second question we have to ask ourselves, where are the orders sitting? Because we know the banks need sellers when they want to buy, and because we know the banks need buyers when they want to sell, we know with a high degree of certainty that if they're going to drive the market down as we expected, then what they're going to do is they're going to come up and induce buying pressure and then sell into that buying pressure. So that goes back to the same point of why it was so critical when we talked about general support and resistance. A very simple fact that almost every single trader is looking at. Trading institutions, hedge funds, all the major news agencies, I don't care who it is, they're looking at it. So when we look at this from the perspective of what are the banks going to be doing, why would they drive it above a high before ultimately driving the price back to the downside? Because very simply, that's where the orders are. So when we discuss where the high probability points are, the first thing we're going to look at, the very first thing, and without this, that level means nothing to me, unless it was a very clear level that the market has responded to in the past, then I do not expect orders to be sitting there. So what that means is that because support and resistance is so prevalent, because all retail traders look at it, if there is not a level that has had response to it in the past, for example, this high, then I don't look at that level as a high probability point. Well, I'm not familiar with Craig Harris, but we have I'm sure a lot of the members could probably, we have a lot of Steve's members. I'm sure they could speak to how we're different. The big thing I would say is the fact that they can actually they find success when they start to learn from us. So I have nothing against any of them, or what's the name of the guy I'm thinking of? What I always say is that if you're not, and this goes to your question, if you're not going to learn from us, what I always say is learn from somebody that teaches market manipulation. So if you're not going to learn from us, learn from Steve. I have nothing against that. What my job is to get you to look, yeah, there you go, Martin Cole. My job is to get you to stop looking at all the crap everybody else teaches. It has failed people for years and people still look at it. So my job isn't to have you learn from me. My job is to get you to learn from at least somebody that teaches market manipulation. Now, do I believe that what we offer is the best? Well, of course I do. What else would you expect me to say? But my job is to get you to learn from, one thing I can say is, Martin's a good guy. I've talked to him before. He, I don't really 100%, I think there's easier ways to do what he does, but I know the guy is solid and I believe in him. And, I can't really speak to Steve, but I've heard a lot of good things about him as well. So my job is to get you just to stop looking at the mainstream stuff. Whether you learn from us or you learn from somebody else really doesn't matter to me, as long as I can break the trance that people are in. So as long as I can do that, then that's the key for me. It's just important to really get back down to the basics and to understand what the banks are doing, and that's really the entire goal here. Looking back at this perspective and trying to get down to the foundation of why this manipulation is so straightforward and is possible to track, is because retail traders are predictable. So the reason the banks are predictable is because retail traders are predictable. So if you're looking from a short-term trader's perspective, and let's just take for example that let's just assume that the end of this gray box here. I'll let the mouse catch up. So the end of this gray box here, let's just assume that the price has not gone past that. So let's just, disregard that for a while. Disregard the market coming up near those highs for a while. So looking at it from the perspective of where would the orders be sitting on a retail trader's perspective, if you look at it from a retail trader's perspective, the most common way to trail a stop is to trail a stop beyond the last high. So there's a reason why once we saw the push above that, the rejection back down below, there's a reason why many people were jumping on that trade. Now there's other things to this trade, but the bottom line is there's a reason why they're predictable. And once we have market cycle, we can go back and within that day, we can go back and we can look at those high probability points and move on from there, and know which points the banks are going to run into. Let me go and look at, let's see here. I want to go back and I just want to illustrate a quick point, guys. I'm looking at an hourly chart, and I'm just going to, I had picked this time just because this is where I was at when I was looking back. Okay, so, and I'm just going to illustrate a basic point here. When you look at it from an hourly perspective, and this should really kind of to hammer some base before this move started to the downside here, as you look at this move down here. So as the question we got to ask is, why does the market break above the high before starting its move to the downside? As we scroll forward, at the end of this entire trend to the downside, why does the market make a false push below the lows before getting rejected back up? As you continue forward, move this down. Why do you see the market break above the highs again before getting rejected back to the downside? Same thing here. We'll let the market, as we look at it here again, why does it break above the highs before getting rejected back down? And you could go through this all day long and scroll forward, and what you're going to see, and this is the same thing. This is again, I got to let the screen catch up to what I'm saying here. Why do we see the market break above the highs before the immediate rejection to the downside? The basic principle of understanding the stop run, and I'm going to go back to the current price, by the way, but the basic principle of understanding where retail orders are sitting and then waiting for the manipulation at those locations is something that gives us a huge edge in the market. So when we combine that with market cycle, what we have is we have a very good overview of more than likely not only the expected direction for the day, but also the high probability manipulation points where we expect to see the bank manipulation. Now, in general, what is manipulation? As just a quick overview, manipulation very simply is seen when the market breaks above the point we expect and then very quickly gets rejected back down below it. So there's a reason why a lot of members took this trade, because it broke above the highs, was rejected back down below, and showed a solid stop run of that overall high. It's the same reason that as we scroll forward on the pound, the deeper manipulation level that we were looking for on the pound. So as we look at the chart, we had seen a first push to the upside, and the second deeper manipulation level we had was 6,100. It was 6,100 for a few reasons. We had a lot of confluence there. It was a psychological barrier of 6,100. Retail traders How many people understand or know of psychological barriers? I'm guessing out of the 170 people in this room, I'm guessing probably 150 or more understand that orders sit in and around psychological barriers. When you look at the most common EAs that are used, or excuse me, the most common moving averages that are used, the 200 EMA is probably one of the most common moving averages used. You put that in combination with the fact that that level has had a response to it in the past, and all the points of confluence together represent an area we should be looking for manipulation. So do we know for a certainty that they're going to create the manipulation at that level? No, we don't. What we do is we wait for the market to get into that point, show us the stop run at that level as we had here, and give us a valid reason to take that entry. So there's many fail-safes built into the strategy. It's number one, we start with market cycle. Number two, we pick our high probability points. And then number three, we let the market come into those high probability points, show us the manipulation. Once we see the manipulation at the high probability points that we've already pre-selected, that's when we take a valid trade. This is something that doesn't take forever to learn. There is a massive amount of information on the front end of the site. I would urge you guys to, at the end of the seminar, I would urge you to watch, again, this link, and that is the first video in a 3-part series. At the end of that video, on that same page, right below the video, it says watch the next training video in the series, and it goes to part 2. So again, after the seminar, I would urge you to go watch that video and watch the other 2 that are associated with it. It will break down the strategy to its base through those 3, through those 3 videos. This block right here, so this block, this tall, skinny block that you see each day, is the 8 to 11 a.m. block. So that's the time we look to trade during the New York session, 8 to 11 Eastern. If you don't know what Eastern time is to your time zone, go to Google and type in world clock. Look what time it is in New York, and then you can figure it out in relation to your time. So we look to trade during this tall, skinny gray block, which is the New York session, the 8 to 11 a.m. time. And then we look to trade the first 3 hours after the first 3 hours of the European and London Open, so from 2 to 5 a.m. Again, I can write that in. Now, why do we look to do that? Why do we look to trade during those times? Now, those are links that go to the front end of the site. Those are not member links. That's free information that's on the front end of the site. So why do we look to trade during those times? It's important to understand that one of the bank's main jobs is to process what we term as general order flow. General order flow is the process of orders for the processing of orders for general worldwide commerce. So if somebody's in the UK and they trade their product to somebody, or they sell their product in the US, they're going to get back US dollars. Therefore, in order to buy whatever they desire, they need to exchange those dollars back into pounds. Or if they need to go buy some supplies from Australia, they need to change those dollars into Australian dollars. That's what we term as general order flow. So looking at it from that perspective at the beginning, looking at it from the perspective of general order flow, why is that critical? Well, it's critical because looking at it from that perspective of general order flow, during that time is typically when those orders are processed. So let's look at it from the perspective of, let's just say we're Citibank and we process orders for a certain amount of clients, and on any given day, they're going to either be asking us to exchange dollars into pounds or pounds into dollars. So those are orders that we need, that the bank needs to process. Now, generally, these orders are processed at the beginning of a session. That's often why at the beginning of this session, they're at the beginning of any sessions, when you have the most volatile times, and typically when you have the highest probability of seeing market manipulation. So looking at it from, again, that perspective, that general order flow is used by the banks to manipulate the market. And because general order flow is processed at the beginning of sessions, that's why we look to trade the beginning of sessions. So for example, if they're going to look to sell them, or if they're going to look to buy the market, there's a reason why at the beginning of the session they'll push through all their sell orders, drive the market, as we had here in this case, beyond a low, and buy into the selling pressure. Much of what we do here, and I'm sure that a lot of people, they hear it one time and it doesn't make sense right off the bat, and that is extremely common. I can assure you that, if you go through just what's on the front end of the site, you'll have a very good understanding of what it is that we do here. You'll at least have the very good basic understanding. That way you can start spotting this manipulation. You can, even if you're going to continue to use whatever strategy it is that you use, you're going to start to look out for this manipulation during those high probability times, which is, again, 2 to 5, 8 to 11 a.m. Eastern. During those times, at the very least, hopefully you'll watch for that manipulation in and around what we term as high probability points. And video 2 in that series covers more specifically high probability points. Market news, especially nowadays, is used to create manipulation more than anything else. There's a reason why with a lot of market data, you'll see it spike beyond a high. In other words, you'll see the news used to spike it beyond a high or a low, and then they'll reverse the price from there. So in other words, they use the lack of liquidity and the drying up of orders to spike the market beyond a higher low and turn the market from there. This big Asian block, just for one final time on the block here, guys, or on the times on the chart. This block ends at 2 a.m. and therefore the time in between these two blocks is 2 a.m. to 8 a.m. The New York block is from 8 to 11. When a trade sets up, yeah, we will call a trade. That's not the purpose of the room. One of the things that, just as a general, what we're going to do now, guys, we're going to get into some questions. If you guys have questions, we're going to get into that. One of the things that is in relation to your question there about the Day Trading Forex Live itself, the original first 2 years of the service were strictly a live room, and we just called trades live in that room. One of the things that I've found out over the years is that traders don't learn in a live room. It's our goal, Chad and I's goal, when we talk to people in a webinar, when we put information on the site, or for our members, our main goal is to get them to trade profitably on their own. Unfortunately, it tends to create traders who become reliant on Chad or I. So although they'd watch us trade profitably live and they'd watch all of our trades live, they weren't able to do it on their own. And when we started giving people in the daily market reviews, we started giving them the exact trade plan for the day, meaning we'd tell them in the daily market reviews, we tell them essentially a signal for the day, the direction as well as the points to look for the manipulation. They're the ones that at the end of the day have to still pull the trigger. So we found it really helped to kind of take a little more hands off and allow them to take the trades on their own. What I would ask you to do, as far as your question there, what types of candle formations we look for to know the manipulation, the basic principle in the case of market manipulation of a point to the low side is we want to see it break below the manipulation level that we're looking for, and then very quickly get rejected back up above. The video that breaks all that down is the third video in that series. And again, I'll share that link again at the end of the session if you guys don't have that. All right, guys. Do we have any general questions as to what it is we do? I know that, and obviously you guys understand within an hour and a half we can't break down everything, but hopefully we've at least shared the general overview. If there's something about that overview that you don't understand, what we wanted to do in this seminar was go over the very basic foundation of why it is we believe what we believe. So we wanted to break down that the brokers are telling you that they would never teach you anything profitable. So then what we wanted people to do is we wanted them to go look at actually what the brokers are teaching, and then that will give you a list of everything that's not profitable, because they've just already told you that you need to watch out for essentially anything they say, because they take the counterparty trade to what they are the counterparty to your trade. So that's an extremely important point. And we want to break the myth about the fact that the Forex market is not manipulated, because the manipulation is actually the single biggest thing that we're going to look for to give us the single biggest thing that we're going to look for to give us an indication of what the banks are doing for that day. Guys, just really quickly, what I wanted to do before we get into these questions here real quick, what I'm going to do is I'm going to go ahead and let me go over this real quick, guys. Just real quick, I'm going to put in the announcements. There is one of our members has been, really cool to open himself up to people that have interest in learning to trade what the banks do. And Robin has been a member for a while, and he's really helped a lot of members and non-members have an understanding of exactly what it is we do, and whether or not, or any questions that you may have on it. So what he's agreed to do, which I thought was pretty cool, is he's agreed to take any questions from anybody that has questions, as in regards to what it is that we do, or in regards to the service that we offer. And so let me type this in here. What he's done is he's got essentially a phone number and a Skype, and you guys, if you have any questions, you're more than welcome to shoot him an email or a phone. So let me write this in here. Actually, Robin, are you around? Would you mind writing that in again? I can't for some reason get it to write in. You could write it in the announcements, and that way I can start going through questions. Okay. All right, guys, let me pause with the questions for a minute. I'm going to scroll up, and I'm going to start asking questions. If I missed your question, I understand there's a lot of them, and we'll try and get to as many as possible here. Question was, so we would trade about 3 times a week depending on bank trading cycle. No, not necessarily. It depends on the sessions you trade and how, if you trade both sessions, if the cycles are clear and if the manipulation's there, we can get more trades than that, or we can have fewer trades than that. It really just depends. And, you got to take into account, if we've seen 3 cycles down, it's possible they're going to reverse the market all within that 1 week and continue to reverse the price in the opposite direction. So not necessarily, it's not necessarily that we'd only have a certain set of trades that week. Jersey, one of the things your question was also, what makes the second push a close above the high of the first? The best thing that you can do to get an answer to that question is watch that first video. I believe, actually, I'm not sure if you remember or not. Name sounds familiar. So if you're not, the first video that I posted a while ago, that will answer it quite a bit more. It just would answer it a lot better. So cool. Thanks for posting that, Robin. And again, Robin, that was, I'm glad Robin, we kind of twisted his arm to get him to do it, but he, he's been a member for a while, and it gives a little bit different perspective. Sometimes because I repeat this so many times, sometimes I don't always explain it. There's certain little nuances that somebody who's been in your situation, who has then learned the strategy, can answer things from a little bit better perspective than I can. And that's what's really cool about Robin being willing to answer any of your guys' questions. So if you have any, feel free. He put his email and phone in the announcements. When it comes to market cycle, your question is the daily chart. It might say is it possible that we're in the second level. What's important to understand, guys, is that when we look at market cycle, we look from the hourly chart. Now, the hourly chart is going to give us market perspective, and in that video, it's going to break down all the little different nuances to what is a cycle. What makes up a cycle? How do you determine cycle? How do you determine what cycle you're in? The second video is going to break down how we determine high probability manipulation points. The third video is going to break down what do we do once the market gets to those points. And those three videos are going to give a basic overview of essentially what it is we do. The manipulation, very simply, there's a reason why all moves, almost all moves will start. I don't want to say all moves, obviously, because that's not the way it is. Most moves will start, if they're going to run the market down, and this is a very simplistic overview. Understand that this is not a basic, or this is, as we look at this and we see, in this example, there's a reason why the market broke above that previous high, and that's where the market started to work down from. So how it manifests itself on the screen, Andy, is you will see the break above the major level. And again, it's important to pick the proper high probability points. So when we come into a proper high probability point, we see the market break above it and then quickly get rejected back down below. That has given us a very good indication that the stops were taken above that point. It's the same way as we go when we scroll forward. The second or deeper high probability point we had talked about for Friday. So the second point that we were talking about in the daily market review was 1.6100. Now, why did we mention 1.6100? Well, it was a point of confluence. I'm not going to get into every part to that, but that was the high probability point we marked. So when the market comes into that level and we see them break below that and very quickly get rejected back up above it, that gives us a good indication that stops were taken. So there's one thing that we know. If they are, you got to ask yourself, what type of order is below any support point? You have really, while there's many types of orders, in general, you have two main types of orders. In this case, you're going to have the stop loss for anybody that's long. And the second type of order is you're going to have those that are looking to sell on the break of that level. Therefore, that's telling you that below any support point, you have a massing of sell orders. So if you see them run into those sell orders and immediately buy up all those sell orders, quickly get rejected back up above it, that's giving you a very good indication that they were buying into the selling pressure. If they were buying into the selling pressure, then that gives you the direction. That's telling you that they are looking to accumulate that long position. It's just the exact opposite for what we talked about back here. So again, letting the chart catch up, and we look at it from the opposite perspective. Above any resistance point, what do we have? We have the stop loss for anybody that is short. In addition to, which, what is the stop loss if you're short? That's a buy position. You have to buy it back. So the flip side to that is those that are looking to buy on the break of that level. So you have a massing of buy orders in general above most resistance points, and you have a massing of sell orders below most support points. So in this example, when they run the market into those buy orders and immediately reject the market out, that's showing you that they were as soon as they ran into the buy orders, they were selling into the buying pressure, and the ensuing price action confirmed that. To the overall high, you're talking 330 pips. So this move is so far outside of what normal is, that more than likely come Sunday, we're not really going to be paying too much attention to market cycle until things normalize on the euro. More or less on the euro come Sunday, we're going to be looking at high probability points and trading them without too much directional bias based on cycle. June asks, sorry, I meant, why do you teach your strategy? Well, we have such, and this is something I think any of the members in here hopefully would speak to. We have such a good community of traders that Chad and I find a lot of joy in finding people that are successful or creating successful traders. There was a trader I don't know, maybe a day or it might have been a week ago, that posted his track record of his trades, and finally, after years of failing, has become a successful trader. And there's a certain amount of joy in doing that. To be quite honest with you, I was burning out bad with just the live room. I didn't find as much joy in it because I didn't think people had. I didn't see the success in people that I was looking for. Now with the format of allowing people to not become reliant on us, after you start seeing that much success in people, there's a huge joy in that. And there's also, trading is a relatively boring business. So when you can have a very large community of traders, and you can come into the room on Tuesdays and Thursdays, chat with people, you can go in the forum, talk with people, there's a certain portion of that, and everybody understands this, that trades for a living or is looking to trade for a living. Having other traders around you is a big part of it. So whether I taught it or not, I would be involved in some community somewhere. And it's just a bonus to see people that are, possibly failing for years or knew nothing about the market that are finally finding success. Hammond, the one of the most accurate things I have as far as, I don't have my live account attached to a track record. There's a few reasons for that, and we posted, one of the things we posted was a portion of Chad's track record. Now this was, quite honestly, is one of the as far as win-loss goes, it was actually one of the lower win-loss times of his track record. We posted it for a reason. We explained that more in the article that's associated with. When we look at, when you look at the perspective of creating a trader that has their own slight twist to it, what we try and do is in the daily market reviews, we try and give essentially the closest thing to a preemptive signal as we want to give. Now, we still want traders to pull the trigger for themselves, because if they're not pulling triggers for themselves, they're not going to learn. So what we do, so people can see that this stuff works in advance, is that we're giving them expected direction for the following day as well as exact price points. So that's what we do for showing in advance how it works, how it, and that, I guess, not just how it works, but also giving somebody a very good overview of exactly what they should be looking for that day. Yeah, it's Sunday, the market is closed. If you're looking at that video, below each one of those videos, somebody's asking for a link to the third video. You guys, I'm telling you, one of the things I urge people to do, I know people get kind of, I don't want to use the word lazy about it, but click on Forex videos at the top, go through every section of the site. Now, I say that because there's many other things layered in there. So in order to find that video, you want to click through those videos. At the bottom of it, you're going to see a link to it. I just want people to start looking through it, because there's a lot more that people sometimes don't realize when they just get a link. But there's a ton of information on there. There's many recent trades that we have, and so I just want people to become fairly proficient at looking through the site. Hopefully that makes sense. Can you detect a move there is not a stop run? Tim, no, we don't. I do not look to trade unless there is a manipulation there. So Tim's question was, can you detect a move there is not a stop run, or I'll interject, manipulation? And the answer is no. You can detect it based on cycle direction right, or the market. I don't want to say it like that. I'll say it like the banks follow through on the cycle, but they do not show the manipulation. Those are days where we don't get a trade. I use MB trading, Patrick. Some people don't like them. I have always found good success with them. I don't, I don't. One of the things with MB trading is that they don't trade against you. They do pocket the spread. They do deal customer versus customer on small amounts, but they've always been a good broker to me. So that's who I like. I do not recommend brokers because the second I recommend somebody, they're going to screw you, and then I'm going to feel horrible. So I'll just simply tell you who I've used. And question is it wrong to buy the euro dollar in a one spot 33.40, one spot 33.50 range, hoping it would go in an uptrend? It's very important to understand we have a specific criteria for what we look for. If the market cycle is not clear, if the high probability points are not clear, we do not look to take a trade. So one of the most difficult things I have to break with traders is their urge to trade no matter what. The urge to say, I'm going to be in a trade regardless. And that is half the battle with what Chad and I do. When we're working with a member to help them get to the point where they're very selective about the trades, what we do is we hammer home, is that satisfying the criteria? And so that's what I would urge people to do is it's either satisfying the criteria for identifying what the banks are doing or not. If it's not, then very simply, we do not look to take a trade. So what I would say there is number one, you use the word hope, which as a trader we don't ever want to use, but especially in regards to the euro, until the cycle is clear, it's probably going to be a pair that I would avoid. William asks, where is exactly the entry price after confirmation of the manipulation? Well, let's go back to the pound and we'll talk about a trade that was a trade a fair bit of the members caught. Now, and just to be fair to this one, I wasn't around during this time. I don't Monday morning quarterback things. If I wasn't around, if I didn't do it live, then it's not something where I'm going to say I would have done one thing or I would have done the other thing. I don't say that because if I'm not there, I'm not going to say it. I'll talk about trades other members post in the forum because they post it. It's their trade. So where would the entry be taken? Well, we have something that we teach. It's called the confirming entry. The confirming entry is a fairly simple entry. It's one type of entry that we use. So in the confirming entry, and I'll let this zoom in here just a second. So in the confirming entry, the candle that comes in and breaks the manipulation area is what we term as the reversal candle or the first candle in the setup. So how do we know if the market is going to reverse or if it's just going to continue to the upside? Well, we have to wait for the second candle. So the second candle is what we call the confirming candle. The confirming candle in the case of a short has one very simple criteria. It needs to close clearly below the body of the first candle. So as you can see here, this what we call confirm down. It gave us a confirming candle. So after those two candles close, then we let the third candle open and we take the entry when the third candle pulls back and touches the body of that first candle. The confirming entry, I don't know if I have anything on the site on that. You can go to YouTube and you can type in confirming entry, I believe, and you'll find some information on that. Or I can real quick And this, again, this is just one type of the entry. It is the most, it is probably one of the safer entries. That video is a little bit old, but it's still good. So I put the link in there for the video. Okay, otherwise it can be different. Is a stop run a must? Yes, some type of stop run or manipulation is a must, yes. Splinter asked that question. For today's attendees, do you offer a discount for sign up? I don't know. Let me think about it. Dean, you asked, do you raise your membership fee this year? Curious to why you charge so much. If you want traders to get this information, do you really appreciate? I do really appreciate that you keep your postings. The reason the price has been raised, guys, is because Chad and I we can't keep up with how many people are signing up, and whenever we can't keep up with how many people are signing up, we raise the price. The only other option we have is just to very simply stop signups. One thing that we said in the very beginning is we're never going to have too many signups to where we don't take care of our members. Any of our members, one of the things that every one of them will say, I pretty well guarantee it, is that we have the hands down the best support out there. If you shoot us an email, you're going to get a response to that email. If you want to talk to us, we're going to talk to you. So because of the level of support that we offer, we can't have, we can't have 200 signups a month. We just can't deal with it. So what we do is we raise the price to slow things down sometimes. And Dean, I appreciate it. Thanks for the kind words. Karim, thanks for the kind words. Appreciate it. That just represents how wide that box was. Somebody asked, what are the numbers you have on the blocks? The numbers are just, the number below it represents the spread of the Asian session or the spread of the New York session, meaning the distance from the high to the low. You're asking about the euro yen. We're not going to really talk too much about any specific pair because what we want to cover here is we want to cover more or less the strategy itself. That way you can apply it to any specific pair. Thanks, Jersey. Appreciate it. Well, if you don't know all the criteria, the cycle is hard to follow. That's one of the reasons why the daily market reviews are so important, because they give you the cycle every day. And that's something that everybody can learn to do. You don't need the daily market reviews to know cycle. After somebody has learned the strategy and understands it, within 2 weeks to a month, generally they know what I'm going to say in the daily market reviews because they've become proficient at doing it on their own. So in the beginning, learning cycles is something that they're going to have. Does take a little bit of time, but it's also something that everybody can and does become fairly proficient with. Iman, and hopefully I didn't butcher your name, you said, do you post a video of all your trades giving an explanation why and what manipulation points? What we do, just to kind of reiterate, is that the daily market review is posted around midnight. The reason we post it then is so that everybody during the London session knows exactly what direction they're looking for and the exact points to look for a trade. So that's what we do as far as the explaining exactly why. And I don't just say this direction and these points. I explain it all. And so in answer to your question, that's what we do in relation to doing it beforehand. Okay, somebody's asking, can I type the broker's name in the chat? Understand, I'm not recommending them. I'm simply telling you who I use. Can a retail trader with a 3K account get a broker that does not? Okay, I answered that question. Okay, why do we use candlesticks versus bar charts using candlestick patterns? It's important to understand that the candle pattern specifically is the very last part of what we do. It in and of itself means absolutely nothing. A confirming entry, a single candle pin, a chart pattern means nothing in and of itself. If you don't understand where you're at in the market cycle and what the high probability points are, the candles don't confirm anything. The candles are confirming that we've just seen the manipulation. The daily market reviews, Phil, are for the members, so no. Can you post the initial? We trade the hourly chart to identify cycle and the 15-minute chart to take the entries. Most of what we're going to be looking at is always off the 15-minute chart. Well, it's not really a personal question how profitable I was or wasn't. People watched every single one of my trades for years. So that's also, one of the things when people ask me about track record, my track record was out in front of everybody for years. And was every one of my trades profitable? No. And, one of the things I say is even the best hedge funds in the world have losing quarters. Now, I never had a losing quarter, but it illustrates a point, is that losses among any trader will always happen. And one of the things that, during those years where every single one of my trades was live in front of people, we generally maintained, between, I'd say on average, 2 to 10% per month. Some months were a little bit higher. Some months, in general, on any given year, I would have at least one losing month a year. Last year, I had 2 losing months, and I consider a break-even month a losing month. One month was break-even, another was 4% down. So, and again, this is all based off 1% risk. But one of the things that, that is also true is every one of those years, we far exceeded what most hedge funds do. We were off a very small risk per trade, well in profit at the end of every year. I wish, Hussein. One of the things traders will find out is that I don't care if you've been profitable and you're profitable and you've been profitable for years. Every trader will have a mental block. In general, I don't trade over 3 to 5 lots, and it's because I have a mental. For me personally, that's where I'm comfortable. One of the best ways I ever heard it explained was, you may be a great 1 to 3 lot trader, a mediocre 3 to 5 lot trader, and a horrible 5 to 10 lot trader. So everybody has to find their certain comfort level. And, just because you have a certain amount of money in your account doesn't mean you want to trade with, as much leverage as you possibly can. Dean, I appreciate the kind words. Glad you enjoyed it. In general, and this is probably the most important part that somebody can take away, and one of the reasons why people that are tracking the banks have a much higher degree of a higher success rate is because the setups that we look for, because banks have to enter and exit positions over the course of time, once we've identified what the banks are doing, we're not just going to see a 20, 30 pip run. In general, we're going to see a much larger run. So because of that, we always look for at least a 2-to-1 risk reward. We always look for, if we're taking a trade with a 20 pip stop, we are entering, or we are looking for a 40 pip take profit. All right, guys. Well, if you have any questions, feel free and shoot. Otherwise, we'll head out for the day. I've pretty well covered what I want to cover. I want to reiterate, if you guys have any questions about the service or in general about the strategy, you can email or talk with Robin. The cool part about Robin is that he's an actual member. And, it's not just me talking about it, but it's a different perspective that might resonate a bit better with people wondering whether they can actually do it or not. One of the biggest things we want to get across to people is that you can succeed in the market. The market, there's traders that are doing it. We have a lot of proof of that. Now, does it come easy? Does it come without hard work? No, it doesn't. Never. Nothing worthwhile in life comes without a good deal of hard work. Now, in general, we find that people are fairly confused for a week. Things really start to click on the second week, and you have a very good understanding after a month. So once somebody understands what the banks do, and again, it happens if you're going to put 10 minutes of work in a day, well, it's not going to work. If you're going to put in an hour's worth of work a day, you're going to learn it very quickly. It does not require a huge deal of time to learn. One of the things we find, though, is that after somebody learns what the banks do, the application part is what depends on the individual. Some people will take a little bit longer. Some people will take a shorter time to learn how to apply it. But the application is really the critical part. A lot of people like to blame the broker, Patrick. At the end of the day, the brokers are very simply repeating the price that's already there. So the banks are the ones creating the manipulation. The banks are the one creating the stop run, and everybody blames the broker. You go into any forum, Forex Factory, Forex Peace Army, I don't care what it is, and you're going to see numerous people blaming the broker. If they only understood that the brokers simply repeat the price, and it's actually, for the most part, it's going to be the banks that are creating the manipulation. And it's not the brokers that are simply creating the stop run. It's actually the banks creating the stop run. It is not a guarantee that the cycle will end in 3 days. Sometimes it lasts a little bit longer. In general, as you go through those videos, guys, as you break through, as you go through the videos that talk about cycle, one of the things you'll find out is we trade the probability, meaning this is how the market tends to be ran. So this is how it tends to be ran, and we trade the highest probability of how it tends to run. Now it tends to finish around 3 days, but sometimes it'll take a little bit longer. Really, it's not hard for us to diagnose if it's a little bit longer or shorter, though. Well, what I would ask you, Alvin, you're saying, let's say the banks are manipulating the euro dollar. How are you then applying it on cross pairs in this respect? Well, the question I would ask is, why would we try and apply it on a pair that we have to, such as a cross, if it's clear on the euro? So one of the things we try to get people to again keep this as simple as possible. At the end of the day, once somebody really understands the strategy, they'll understand that it's fairly simple. And what we mean by that is there's only 2 questions we ask ourselves. You need to understand market cycles. So once you do, you're going to ask yourself, where are we at in the direction of the cycle? And the second question you're going to ask yourself is, where are the high probability points? Another way to keep that simple is to trade a select amount of pairs. So what I would say is on the euro, while we do talk about cross correlations in the course, what we urge people to do is we urge people to stick with the majors, especially as they progress and understand the basics. I generally, and in this type of a market more so nowadays, I generally look for 2-to-1 as my exit point. If I see manipulation against the current trade I'm in, then I will look to exit, but otherwise I look for a risk-reward target as my exit. I do not look at support and resistance as my exit point. Alvin, there's many different things we could look at. We can look at volume to give us further indication. We can look at many different things to give us an indication of direction. What we try to do is we try to, for our members, we try to take just what is critical information. Because one thing we've found out over the years of dealing with literally thousands of traders is that if you try and bring things too complicated, even for myself, if you try to involve too many different thoughts, it becomes much more difficult to succeed with it. So we want to ask ourselves 2 questions. Where are we at in the market cycle? Where are the high probability points? And once we can master those 2 facts, we'll have a very good indication of what the banks are doing. Now, again, there's many other things that you could probably use, but our goal is to keep it as simple as possible. Well, if there are, then we don't see the manipulation. And that's the point where we don't get a trading opportunity to act. You're asking if there's periods of indecision. That's times where you see what we term as level 3 type accumulation, where you see at the end of a cycle, you'll see an accumulation period where the market is very simply taking stops to both sides of the market. Jersey, it doesn't matter what leverage you have, just make sure that you don't open a position size over 2%. So you could be using 400 to 1 and, still trade safely. Just make sure that you keep a very small risk per trade. Like I said before, volume is one of those things that you could use to give you a bit more information. Over the years, one of the things that we found is that it tends to distract traders. So we don't really recommend it. But volume is one of those things that you can add to. It's just simply a confirmation. You still have to ask yourself, where are you at in the market cycle? Where are the high probability points? You could use volume as a final as a final indicator, meaning a final indicator that is actually manipulation of the market. But again, we recommend keeping it simple and looking for, very simply, in the case of a shorting opportunity, the break above the manipulation and quick rejection back down below. We're going to head out soon, guys. We've been running for close to 2 hours, so it's probably going to wrap up the seminar. Hopefully, at least we answered 1 or 2 questions that you guys might have had. We like to do a general seminar for members at least once a month, or once every month and a half. And so it'd been a while since we'd ran one, so we wanted to do one for you guys. I do not use an MT4 broker. I use MB Trading does have MT4, but I do not use it. Ken, we've been running on 2 hours, and we're probably going to be wrapping up the seminar. What I'll tell everybody, and what I'm going to say here, guys, is pretty important. One of the things that you'll realize with Chad and I, hopefully, and especially, members realize it very quickly, but you guys deal with a lot of, and this is, just to kind of wrap up the seminar, I'll say this. You guys probably deal with a lot of scams in general of people that screw you. Now, we're not right for everybody. We're definitely not right for everybody. And some people may not learn effectively from us. And that's just part of life. Some people don't learn from other people. They just don't seem to jive with the other person. One of the things, in relation to what you're talking about daily market reviews and how they correspond to the charts. I'm assuming you just want to see how accurate they are. What I would urge people to do is, if you have questions about signing up, talk to Robin. He's, like I said, he's a member. He doesn't really have a dog in the fight. So what I'm getting at is, you can get some feedback from him. We don't offer a trial because people tend to abuse a trial. But one of the things I always say is, if somebody signs up and you find out in a week or two that we're not for you, and we very simply are not the service for you, we're happy to give you your money back. Because quite honestly, we put way too much work into our members to deal with somebody who's not willing to put that work back. So that's the way we do a trial. If you don't like it, shoot us an email. Obviously, don't shoot us an email 2 months down the road. But if you don't like it in a month or two, feel free to, or a week or two, feel free to shoot us an email, and we'll give you your money back. But we just don't have the time to work through trials and things like that. But I would definitely recommend contacting Robin. It's gmail.com. He spelled it wrong there, but robindtfl@gmail.com. So, and as always, Chad and I are open to questions, members or not. We're here to help. So shoot us an email if you like. There's a contact form on the site. Either way, we really hope you guys enjoyed the seminar. Sometimes they can go off on a bunch of different tangents, but overall, hopefully it was a fairly informative seminar. No problem, guys. I'm really glad to help, and I'm glad you guys enjoyed it. I'm going to try and get this posted within the next couple days. And I don't just say this, guys. We're here to help. If you have a question, shoot us an email. We're happy to get back with you. And for those who did just sign up, give us a minute to activate your account. We will get you guys going here within the next. And we look forward to seeing you guys as members. If not, make sure if you're not signed up to the free email list, make sure you signed up to that. We try and send out some education once a week. And again, as you go through our site, one of the things you'll quickly realize is that the bottom line is if it's not valuable information, it's not on the front end of the site, and that's just the way it is. So if you're not a member, make sure at the very least you go through the information on the front end of the site, because that's critical information. And again, if you have questions as to becoming a member, shoot Robert an email and he will get back with you. All right, guys, I will see you all next time. Hope you learned something, and we will see you guys later. Have a good one.